So far, the stock market this year has been incredibly volatile. It seems to be calming down a little bit as we're seeing kind of a resolution with some of the tariffs. Now, when we look at the majority of indexes, they are a little bit below where we started a couple months ago, but that's okay. It seems like it's rebounding pretty well. Now, this, and really looking against this backdrop, is the time to be investing into ETFs or exchange traded funds. This is a collection of stocks, not independently and not buying a single stock, but you are buying an entire basket of stocks, which is a really good place, especially if you are a new investor. Me personally, I only invest in ETFs. That is the only place I put any of my money. There is not a single company that I own itself. So what is the reason behind this? Now, when we start thinking of ETFs, you can really use my advantage. And what I do is dollar cost averaging. So every single Monday morning, like we've said before, I put money into the stock market every Monday morning. When you start doing your Google searches, when you start looking at Copilot, they have said time and time again that Monday is the best time to invest into the market. And I have a regular investment. I invest $250 every Monday morning in the market. This is very similar to what you see to 401k plans when you're doing consistent contributions on payroll deductions and investing in the market through dollar cost averaging. This means that if the market is down 5, 10, 15, 20%, I am getting an incredible discount on all of the ETFs that I buy. If on the flip side, the market is up 5, 10, 15%, I am buying it a little bit higher, but the dollar cost averaging overall and over an extended amount of time is going to increase. So when we start looking at a study from JP Morgan Chase, since 1950, the S&P 500 hit all-time new highs 7% of trading days. Think about that, guys. You're talking in the last 75 years, we have seen new all-time highs 7% of all trading days, which is kind of crazy. And on a third of those days, the index never dropped lower than essentially that point in time. So let's break down 3 ETFs that you should be buying, you should be holding. And these are ETFs that I personally do hold in a portfolio. So I want to cover these a little bit more in depth, and I will use some graphics in there, Kookie, so you can kind of see what they are. So the first one we look at is one of my absolute favorite, which is the Vanguard S&P 500 or the VOO. This is a really good reason. This one tracks the S&P 500. It is the 500 largest companies within the United States on the US stock exchange. Now, this is market weighted cap. So what we mean by that, the larger the company's value, the bigger part of the portfolio this is going to hold. Now, you have to remember that because some of these ETFs are a pretty decent overlap, but you'll see how they kind of compare. So looking at this, most Vanguard ETFs has a minuscule expense. The expense for this is a 0.03, which is next to nothing. When you look at financial advisors charging 1%, it seems kind of crazy. When you start looking over, 30, 40, 50 years, if you're giving away 1% of the portfolio over an extended amount of time can be up to 30% of the entire portfolio due to the growth factor. Now, when we start looking at these companies in their entirety, in the bigger picture, you are investing again those 500 largest companies, but you have instant diversification because you are investing in companies from every single sector within that 500 large companies. And over the past decade, the average return in the last 10 years has been 12.3%. Now, I have to stress that because when we start thinking of where bond yields were, when we start looking at the high interest savings accounts, when we start looking at CD rates, they have not even remotely came close to that 12.3% over the last 10 years that we've seen, according to the end of April. Now, the second ETF that we're talking about, and this again is another one that I hold, is the Vanguard Growth ETF, which is the VUG. So very similar to what we see with that S&P 500. This breaks out the option of having large cap growth indexes, which is very kind of similar to buying a lot more of tech heavy companies versus buying everything from the entire sector. So when we look at the large cap growth stocks, that is the focus over the last several years. It is very heavily weighted towards some of the big ones, Amazon, Tesla, and holds 57% of the entire holding in tech companies, which again is a massive. Now, this will have overlap with the VOO, with the Vanguard S&P 500. It will have overlap. Even when you look at the Magnificent Seven, which we talk about, Apple, Alphabet, Meta, Amazon, and then Microsoft and Nvidia and Tesla. Those are the seven magnificent seven. If you're unfamiliar, I had to recall some of those. Good ETF option because last seven, those seven stocks specifically held over 50% of the entire portfolio in here. But when we start thinking in comparison over the last decade, with that S&P 500 yielding that 12.3, the VUG yielded 14.5%. So even getting, I mean, well over what, 2.2% higher than what we've seen in my favorite, which is the Invesco QQQ. Now, if you've seen the commercials, if you've seen some of the innovation commercials, again, this is going to have a lot of the growth factor that we've seen, a lot of the overlap that we see. Now, beating the returns of the S&P 500 is not an easy task, but this ETF with the Invesco QQQ ETF has beat it and has beat it by a significant margin. Like other indexes, it only invests in the NASDAQ 100 versus the S&P 500. So that is the change. So it contains the 100 largest non-financial stocks. So it is taking out all of the financial sector, removing it, and really focusing on some of these growth companies. So when we start looking at the tech sector, again, very similar. It is weighted as 57%, very similar again to that Vanguard Growth Fund. The difference is when we start looking over the past decade, average return of 17% over the last 10 years. Again, when you think of the 12.4% of the S&P 500, the Invesco QQQ is returning 17% over the last 10 years at the end of April, which is kind of crazy. And it's not just a couple of years that we are seeing this outperformance. Rolling 12-month basis, it has outperformed the S&P 500 more than 87% of the time over the past decade. So think about that. In the past 10 years, there has only been 13% of the time that the S&P 500 has beat the QQQ, which is kind of crazy to think when it comes to a bigger picture. So should you invest in these ETFs? In my opinion, the answer to that is absolutely. So the way that I break it down, if you guys are familiar, is I invest in that S&P 500. This is the core. This is the basic. This is the 500 largest companies. This makes up about 33% of my portfolio, or roughly, I believe my personal portfolio is 30% of the portfolio in there, making it very, very important to have as the foundation, as really the basis when it comes to investing. The Vanguard S&P 500 is the basis. Now, when it comes to growth and knowing I have roughly 20 plus years to retirement, 40% of my portfolio is into the Invesco QQQ, and it has performed exceptionally well over the last decade. And I feel like it's going to continue when we start thinking about larger tech companies, when we start thinking of artificial intelligence, quantum computing. All of these companies are going to be included in this basket of the NASDAQ 100 and really making a big difference when it comes to these tech companies and the growth we're seeing out of there. So this sector of my portfolio, the 40% is really focused on growth. We have that S&P 500, which is the foundation. We have the Invesco QQQ, which is the growth part of the portfolio. Now, the third part of my portfolio is the SCHD. Now, this is one that is a dividend kind of larger blue chip companies, the dividend companies that produce income to this portfolio. So I am receiving income from that SCHD. It is investing into the S&P 500, the Invesco QQQ, and also the SCHD itself, depending on where the performance is. Now, right now, the SCHD has really been underperforming because, like we said, it is a lot of the blue chip companies, which are the larger, more well-established companies. A lot of those are very high subject to tariffs depending on where things are made. Because again, these are companies that have been around for an incredible amount of time, might not have the flexibility that we see from some of the tech companies to move a couple things. When you think about manufacturing, when I think of kind of like the basis of Coca-Cola, where it is being produced, where the cans are made, everything of that nature could be really affected by those tariffs. All right, guys, so that is going to do it for today's video, looking at 3 index ETFs that you absolutely can buy and hold forever. So let me know in the comments what you guys think. And as always, thank you guys for watching.